Now, here is Ticky Fullerton on Your Money.
Hello there, I'm Leo Shanahan, every night bringing you a full hour of the very best in business coverage across the nation and internationally, especially where business and politics meet. Coming up, the Myer board lives to see another day as shareholders avoid a spill at today's AGM, much to the disappointment of disgruntled shareholder Solomon Lew. My interview with the Premier Investments chairman later in the program. Coca-Cola Amatil shares spiralling down after the company announces it will proceed with divestment of SPC. I'll be speaking with Managing Director Alison Watkins on the sidelines of today's Company Investor Day in Sydney. And GetSwift pledging to its shareholders it will be more careful with disclosures going forward. My interview with new chairman Michael Fricklas. Shareholders of Australian department store Myer voted against the company's executive pay proposals for a second year in a row on Friday, but have stopped short of a board spill. Owners of 37.5% of the company voted against remuneration report, while 63.3% voted against a special meeting on whether the board should be removed. We heard from major shareholder Premier Investments chairman Solomon Lew earlier today, who said Myer chairman Gary Hounsell should step down. For more on everything that happened at today's AGM, I'm pleased to welcome the Australian senior business reporter Eli Greenbat, who joins me live from Melbourne. Eli, hi. Your thoughts on today's meeting? It was pretty extraordinary.
It was fiery, it was prickly, it was a bit tense at some times. It went for almost 3 hours. There was really a public battle fought at the AGM in front of all shareholders between Gary Hounsell and representatives of Solomon Lew, or Premier Investments, who were in the crowd. You had Jeremy Liebler, partner of law firm Arnold Block Liebler. You had also, interestingly, Jack Kroger, son of Michael Kroger, Victorian Liberal Party president, who's a long-time supporter of Solly Lew. And from the crowd, from the audience, they peppered Gary Hounsell with questions. They attacked him, they attacked the board on a range of issues, from the financial state of affairs, the losses, the cut in the dividend or no dividend, the write-downs, the disclosure or non-disclosure of sales, the search for a new chairman, the search for a new chief executive. But ultimately, in the end, what happened was a vote was taken. And as you said in the intro, Solly Lew and Premier did get their second strike against Myer, but really fell well short of a spill motion of getting rid of the board. So we go back to where we started really yesterday, where you've got Solly Lew fighting a war with Myer. They've got the second strike, but now we're not sure where it goes to from here because nothing really has changed. The board is still there, Solly is still there.
Well, exactly. And what is Solomon Lew's next move after this? I spoke to him earlier. Obviously, he wasn't completely forthcoming with his plan. But I mean, where to now for Solomon Lew? I mean, does he agitate further over this period? Is there going to be a truce over the Christmas period, do you think?
I think you can forget about a truce. I think Solly Lew never really telegraphs his punches, even to his closest confidants and advisors. They don't know what's coming sometimes. It's a shock to them. So I think what you're going to see is Solly Lew and Premier sitting back for a moment, watching how those Christmas sales go. That is the key thing. You might remember that it was around this time last year when we had the Myer AGM and shareholders were told things were fine, that we then had soon after that the first and second kind of profit warning and profit downgrade, where their shares collapsed and the then CEO Richard Umbers was booted out. So I think they're going to wait to see what happens with Christmas and the first month, in January is Boxing Day sales. But I think you'll still see Solly Lew and Premier agitating from the sides, writing letters, holding press conferences, putting out these colourful kind of theatrical letters and statements that the press, of course, pick up on and that Myer can or cannot respond to. So that will continue, but this war will continue. I don't think Solly Lew has ever given up, and he's not giving up now, I would suggest.
Do you think ultimately he would like to see Myer placed in administration because of his position, whereby as such a beneficial creditor he could really scoop up the company?
Well, that's a big question too. As you've kind of hinted there, Solly Lew, through his family companies, his public companies, is the biggest supplier to Myer outside of cosmetics. So he's a big creditor there. He's a big supplier to Myer, but he's also the biggest shareholder. Look, I don't think he or the banks want to see it collapse. The only benefit really of a collapse or administration is that Myer can walk away from its leases, and that's the big problem which is hanging over Myer. Those leases, they're too long dated, they're too expensive. Myer needs to get out of those leases across the country. An easy way to do that is to go into administration, but a lot of pain comes with that. So I think what we can see so far from what Solly Lew wants is that perhaps Solly Lew wants to have boardroom control without launching a full takeover. So he gets control of the board through his advisors or his confidants or people he likes going on the board as new chairman and directors, and perhaps he controls it from behind the scenes without launching a full takeover.
He wouldn't want a board seat himself, though, do you think?
No. Yeah, I don't think so. And we saw that earlier this year when Solly Lew put up his nominations for a reconstituted Myer board. He did not include himself. He did include Tim Anthony, who's a close supporter of his and a member of the Premier Investments Board, also on Breville, which Solly Lew controls through Premier. He included another director of Premier, who's a former boss of the old Mike Grace brothers, but he didn't include himself. So I don't think Solly Lew necessarily wants to be the chairman of Myer or director, but I think he wants people he trusts and likes and respects to be on that board, and that's who he'll be trying to put there.
All right, senior writer with The Australian, Eli Greenblatt, thanks so much for joining us from Melbourne.
Thank you. Thank you.
Well, for more on that, I spoke with Premier Investments Chairman Solomon Lew. Solomon Lew, thanks so much for joining us.
Pleasure, Leo.
Now, you've succeeded in having a second strike against the board on the REM report. However, you failed to get the spill. Will you return now and think again about what your next move is? What is your plan now?
Well, I think it was a resounding success today for shareholders. The arrogance of the board showed through. You had 43% of the register vote against a brand new director. You had 36% of the register vote in favour of the spill. And you had 38% of the register vote against the remuneration report. I think that's just, it shows the arrogance and the upset by shareholders to the massive loss that they've sustained over many years. And I think it's about time that the board understood that their time is up and that they must go.
So you think despite the failure of the spill, the board should resign?
Well, I think that 36% from nowhere, this is unprecedented. Two votes of no confidence. It's unprecedented in a company of this kind. I can't recall any other company having two votes against the remuneration year after year. And I think that if it continues, it'll only increase.
Okay, so what were your discussions with other major shareholders today, and indeed non-major shareholders?
Well, shareholders have voted with their feet. If you look at the number of shareholders that have voted in protest, it's just amazing. They've had enough. They've lost, many of them have lost 90% of the value of their investment. They have an unmarketable parcel that they can't sell, and they're having to deal with a board that has no retail experience, a chairman that appointed himself as executive chairman at $1 million per year pro rata, while shareholders are not receiving any dividends at all.
Well, on Myer's chairman, Gary Hansel says your comments that Myer could fall into administration are fanciful, hypothetical, and he's called your campaign vindictive. What do you have to say to that?
Well, Leo, I've never said that they would go into administration. I was asked by one of your colleagues whether it's a possibility, and my answer was, well, it could be a possibility.
Some would say that
they're trading very poorly currently. As we saw, their first quarter, the sales were double the decline of the first quarter last year, and all they had to say was, "Oh, we made a slightly less loss than last year, a less loss than last year." So you tell me. We're coming into the Christmas period now. We're coming into the best time, and the shareholders couldn't even get a forecast out of the board today of how they're trading.
So it's your view that
if you ask me how they're trading, if you were to ask me how they're trading. From all the anecdotal evidence that exists outside, I will tell you that they are trading probably worse than what they were trading in the first quarter of this year.
On those sales figures, is it your view then the board and the company's failed in its continuous disclosure obligations to the ASX?
Well, just look at the class action suit that's currently before the federal court, which is due to be, some result is due to be announced imminently. They're in court at the moment for a class action for not dealing with the shareholders on a credible basis. There's 7,500 shareholders that are involved in this class action suit. It's not chicken feed.
Well, some say that you actually benefit from the company going into administration. You would be in a good position, arguably, to pick up the company on the cheap. Are you trying to buy the company without having to pay for it?
Well, Leo, we've repeatedly made the statement, I'll repeat it again so that you'll hear, we have no intention of making a takeover bid for this company.
If the company were to go into administration, would you perhaps attempt then?
Well, you're asking me a hypothetical question. The company is not in administration at this point in time. You're asking me a hypothetical question. I really can't answer the question, but to go back to your first part of the question, we have no interest in taking this company over. What we do have an interest in is that the shareholders get together and form an independent board to run this company, an independent, experienced board to run this company, because that's what the management needs. That's what the company needs. And the company needs investment. It needs dollars spent. They cannot, today at the meeting, they did not even mention closing a store or closing floors or getting rid of their redundant stock, you know, the Salvation Army stores. They didn't even mention it. The reason they didn't mention it, because it's going to take further impairment. And these people don't have the headroom for any impairment for the future. The banks are now controlling this company. The banks tell them what they can do and what they can't do.
Some say you're causing more trouble and you're not actually offering solutions. So what would you like to see happen as far as the board goes, despite, except for dismissing it, of course? What would you like to see actually happen?
Well, I'm not in a position to give any advice to the board, to this board, because this board wouldn't even know the front from the back. So when I visit stores, Myer stores, I ask them, when was the last time you saw a Myer director in your store? Answer, I don't think we've ever seen a Myer director in our store. Now, I'm aware that John King stated that he's visited 55 stores in the short period of time that he's been in Australia. But what can he actually do? If you don't have a bank balance to go and fix the problem, what can he do?
And just to be clear, does John King have your support?
Well, I voted in favour of his rights today for his shares because I'd like to see John King succeed. But John King will not succeed under this current board.
It seems that a central problem for Myer is this issue of leases and the long-term agreements they've got with shopping centres and property owners. Is there any way out of that real conundrum for them?
Well, there is. They've got to buy their way out. You need money to buy yourself that freedom. They're locked in. There's $3 billion worth, I've read recently in the newspapers, that there's $3 billion worth of lease liabilities, but they need to be able to have cash to buy themselves out. What they did was they gave the keys to the stores to the bank without seeking raising of any kind of money or keystone investors to come in and put money into this company to rebuild the group.
We're coming up to two of the most important months for Myer. This is the Christmas period and into the new year. Will you cease fire in this period just to see how sales go? Do you expect them to go at all better this year?
Well, I think that the difference is this, Lee. I've been in this business for over 55 years. You're dealing with novices at the Myer board. So they have no idea of what is happening on the shop floor. I could say positively that trade for them will be very tough.
All right. Well, Solomon Lew, thank you so much for joining us.
Thank you, Lee.
More Myer madness. Well, after the break, Coca-Cola Amatil shares slide after the company commits to divesting from SPC. We'll discuss the company's profitability going forward with Managing Director Alison Watkins.
You're watching TICKY on Your Money. Now, back to TICKY.
Welcome back. Well, Coca-Cola fell the most it has in 4 years after the company says it will offload its struggling SPC processing unit. However, CEO Alison Watkins stated there are no plans to close operations before finding a buyer. Coca-Cola Amatil still expects to see its SPC food packaging unit to record a full-year loss of about $10 million. Meanwhile, the company says it's targeting a return to mid-single-digit earnings per share growth in the medium term. And for more on the future of the business, I'm pleased to welcome Coca-Cola Amatil Managing Director Alison Watkins, who joins us live from the Coke offices in North Sydney. Alison, thank you so much for joining us.
Pleasure, Leo.
Now, look, we have to start off. This is obviously a disappointing day for you. This is the worst share market performance, I believe, in about 4 years. Is this the worst time you've seen as in your time as head of Coca-Cola Amatil?
Oh, look, I'm a bit surprised at the strength of the reaction. We have had a good run, and look, I guess investors will digest the information that we provided today, and we'll just see how it pans out over the next few days and weeks. But look, really, the news was around, first of all, great performance in our businesses in New Zealand and alcohol and coffee. A transition year for Australian beverages, which we'd already flagged. Indonesia is soft at the moment, and then SPC, that's really just a next step in the process that we'd already flagged to look at the various strategic alternatives for that business.
Sure. Now, SPC is obviously the big announcements. What is the plan? How can you maintain a commitment to keep the business open if you're willingly or have to sell it off?
Well, SPC, we've really invested a lot. We've invested something like $250 million since we've owned it, and $100 million of that over the last 4 years, which was a co-investment with the Victorian government. They kicked in $22 million, we kicked in $78. And that investment, particularly the latter investment, has really shored up the future of the Shepparton site and the business overall. So you might remember back in 2013, there was a real possibility that that site would have closed. $100 million has taken that site a long way now towards being modern, low cost, and able to produce a lot of products that we couldn't do before. And we're really seeing a lot of the growth opportunities start to gain traction. It's still early days, but we think that by finding an owner who can really focus on the business single-mindedly and accelerate that growth, that business will come through and will come to good, strong profitability. But it wouldn't make sense for anyone, given what we've done at Shepparton now, to do anything but absolutely focus on growth and making the most of the opportunities the business now has.
Yeah, is that only because, though, there was this government partnership, as you've just said? I mean, do you regret this deal, and what does that say about the government coming to the rescue of businesses that might just be failing?
Well, it was a pivotal time, and obviously SPC plays a really important role in Shepparton and the broader Goulburn Valley. So, you know, I think it was the right thing, absolutely, for the Victorian state government to step in the interests of not only the employees at Shepparton at our SPC site, but also for the broader economic activity in the Goulburn Valley. So it was an investment that together we made into the assets and facilities there at our manufacturing site in Shepparton, and it really has secured the future of that site and therefore the economic benefits for the region. So absolutely the right thing to do. It really, at its heart, it's an investment in the community.
All right, well, let's talk about the Indonesian business. Many thought that was kind of your big hope. It seems to have slowed down a fair bit. What's gone wrong there?
Indonesia, it's still an emerging market, and emerging markets will have their ups and downs. We're really confident in the future of Indonesia. I mean, you only have to look at the demographics. It's a 250 million population country with a very young population and GDP growth still rising and with a long way to go. Predictions have Indonesia as being the 4th largest economy in the world by 2050. So it's a very significant market and one we're fortunate to have such a great business in. It does go, you know, it has its ups and its downs, and GDP growth is still 5%, but that's not quite as high as it needs to be for a country like that, particularly where there are a lot of pressures on relatively limited discretionary income. So that certainly had an impact on our categories, on you know, particularly sparkling beverages and teas and juices, which are the categories that we're stronger in. However, the government up there is really committed and encouraging investment. They're putting a lot into infrastructure, and we fully expect that economy will come through this cycle, this stage of the cycle, and perform very, very strongly again, and that'll have a disproportionate upside for our categories. So look, in the meantime, we're absolutely doing everything that is within our control, and we do have a very strong business. We have very strong and clear plans, and you know, I'm confident that we will continue to grow that market.
Yeah, well, as you mentioned, the story of Coca-Cola, I suppose, both Amatil and globally, has been that of diversification outside of soft drinks. Coca-Cola actually made an interesting acquisition in Australia, the kombucha acquisition. Are you looking to buy into that company as well? And what are other kind of products you can move in? Is there much space in the Australian market?
Well, we work very closely with the Coca-Cola company, and so we'll be the exclusive distributor for Mojo, which is a wonderful brand in the fast-growing kombucha segment. So we're very excited about that. In fact, we're already getting underway and working very closely with the Mojo team.
And what of other products, though, in Australia, other acquisitions? Where do you move? Of course, globally, Coke took the Costa brand. Can we expect similar acquisitions in Australia or in the region?
We've already got a really strong portfolio. You know, we've got more than a third of non-alcoholic ready-to-drink here in Australia. We've got positions across the majority of categories. We've now added kombucha with the Mojo brand. We've also invested in Made Group together with the Coca-Cola company, and we're very excited that we'll be able to begin distributing brands like Rockaby Farms, Impressed Juices. So there's some really great premium brands that take us into categories that we're not so strong in. So look, overall, I think we've got a very, very good product range. You know, we're really focused on our core categories, and it's exciting to see brand Coca-Cola coming back into volume growth. It's exciting to see the innovation and progress we're making with our Mount Franklin brand, the partnership with Monster that we have in energy, our progress with Barista Brothers in dairy. These are all really very, very encouraging and telling us that we're really backing the right plans.
All right, Alison Watkins, thanks so much for joining us.
Thanks very much, Leo.
All right, time for a quick break. And public hearings conclude for the Banking Royal Commission, wrapping up 69 days of testimony. I was there for a fair bit of it. We'll get the wrap from the Australians, Michael Rodden, and Sky News political reporter Annalise Nielsen.
This is TICKY on Your Money, covering the big business stories.
Well, just a year ago, GetSwift was considered one of the ASX's tech darlings. With a rocketing share price and successful capital raisings, that was until it got caught up in a disclosure scandal over supposed deals with major companies like Amazon and Pizza Hut. That and other major disclosures problems have seen its share price plummet by more than 90% and led to class actions by shareholders. Now, new chairman Michael Fricklas is at the helm. He's the former in-house counsel and an executive vice president at media giant Viacom. Is he the man to save GetSwift? I caught up with him earlier today. Michael Fricklas, thanks so much for joining us.
Sure, glad to be here.
Now, my first question goes to one of trust. Obviously, this is central to GetSwift. They've lost 90% of share price over the last year. Can people actually trust what GetSwift is saying?
GetSwift is, I think, at this point in time, a trustworthy company. It's always been a trustworthy company. It's a little business, you know. It's a fast-growing enterprise technology business that went public only a little more than a year ago, and I think the market got very, very excited about the potential and wasn't always thinking about the fact that all the elements that go into growing a business. So, Bain and Joel are pretty straightforward entrepreneurs. They've been building a business each brick of the way. Everything that has actually been said about the company is true. What we've done over the last few months is begin to build a strong independent board of directors to enhance the market's understanding of who we are and the ability to trust what we're doing. We're trying very carefully to provide information only that's very solidly grounded in actual data, as opposed to the more prospective, forward-looking information that allowed the market to kind of take it to places that wasn't ever really intended.
Is there a corporate governance problem at GetSwift?
Yeah, look, what the company disclosed its business model all the way back when it first went public. Live disclosure documents all along the way. And the way the business works is you sign up, it's almost like a master services agreement. You sign up a company, you take that company, and it's an opportunity. Once you've signed, you get in the door, and then you start actually selling your product. So there are integrations to do, companies can try it, there's usually a free period, and there's never a guarantee as to how many transactions the company's ultimately going to deliver, and the transactions, of course, are how we get paid. So it's a great business model for a customer because you can try it, and you can see if it grows and see if you like it. Inside a big company, there's still a sales cycle, even after you sign that first master services agreement. So what I think the market, or at least various participants in the market, some of your competitors in the news, are saying, oh, well, wait a second, once you disclose that you sign that master services agreement, now you have to disclose everything that happens after that. Every time you met with somebody, every time you rolled it out, if it grew, if it didn't grow, what's the length of time. The company never really intended that, nor would it actually really be practical. So I think the company was following what it believed its obligations to be under continuous disclosure, which is a tricky thing under the Australia regulations. And I think the question of whether you make those disclosures and then kind of lots of developments after that then become the kinds of things that you have to disclose on a continuous basis is not the obligation. But that's where the company, some people found themselves. So what we're trying to do is we're trying to really focus people on revenue growth, on actual delivery of transactions, and not all of the forward-looking stuff. Oh, we just signed a contract with somebody. It's almost like, would almost be like disclosing, hey, we are making a sales call on somebody, or we're partway down the sales cycle on a company. That's not what mature companies do. And so we're really focused on showing people those things that people can really count on, which are significant double-digit growth in revenue, significant double-digit growth in transactions every quarter.
What you seem to be saying is that GetSwift didn't understand its requirements of disclosure under the ASX.
I think that it's not really well understood by small companies what it means to be a public company. I think that being a public company comes with a whole bunch of governance obligations around it, and it's expensive. And I think people don't necessarily factor that in to what's involved in raising capital in the Australian marketplace. I think it would be better if more people who were thinking about doing that understood what the added expense was and what the added overhead was of doing it. Large companies, I came from a large public company. We have a lot of people devoted to making sure that all the disclosure things are right, every number's right, every every development of the company is correctly and appropriately disclosed and all of those things. We've built that now at GetSwift at a size appropriate for a small company, but I think people, when they do that, don't necessarily understand all those elements that are involved.
Yeah. Now, obviously, a lot of people did lose money in the last year. There are several class actions on foot. What's the latest with those? Where are we up to?
I'm confident the company can survive it. So in connection with the class actions, there were 3 different class actions that got filed. Those class actions were narrowed to 1 by the judge in the underlying case. That decision to narrow it to 1 has been appealed. The appeal was ruled in the favor of having a single class action go forward and not 3. And in the courtroom, the size, enormous numbers were thrown around in the beginning, but those sizes have come down substantially. So now there'll be a phase where people decide whether to opt out or not in the class action that continues pending. That'll finally give people an idea about what the scope is. And then, then we have the opportunity to present our defense. So we think we have a very strong defense. We think that in light of that very strong defense, the cases will likely be resolved in a favorable way. I can't predict, what the number will look like. I can't even predict exactly what the time will look like. But I think given the cash resources available to the company and the rapidly reducing size of the overall exposure in the class action, I don't really think the company's viability is threatened at all.
As well as class actions, there's an investigation by the corporate regulator ASIC. What's your understanding of where that's at?
I can't tell you. I really know. Yeah. They keep to themselves. It's continuing. We've cooperated with them every step of the way, and beyond that, you have to ask ASIC.
I want to understand a bit about your background, why you took this job, and the circumstances under which you took it.
So I'll give you a little bit of background. First off, I came many years ago. I came out of high school really being interested in internet startups or technology startups. I actually had a little company when I was 17 that was involved with some technology involved with personal computers in the very early days. Went to engineering school, got a degree in electrical engineering and computer science, and then decided that to go to law school, where then I came out and represented technology companies in the Silicon Valley. So really enjoyed that. Along the way, other opportunities came my way. I actually came into Viacom, so a big U.S. media company, in part because the media business was evolving in a technically interesting way. Technology was becoming more and more important to the media business. So for me, that was a great opportunity to continue to expand that in the media space. But I loved the idea of working with these companies that are really emerging growth companies and really changing things. Yep. Second, I'd worked with Bain Hunter, the CEO, when he was at Viacom. So one of the things in my purview was content protection, and Bain worked on the technical side on content protection for Viacom. So I got to know him, and I got to like him and admired him. Viacom went through some changes, and the COO left in 16, 17, and I left beginning of 17 after taking a really nice long vacation after 24 years there. Was looking around for various things to do, and one of the things I did was actually get involved with the Governance Center at Columbia University. So Bain saw I'd gotten involved there, and he called me up and he told me the story of GetSwift and going public, and the AFR story that raised issues that he felt were completely unfair, but said, now here's where we are, can you help me out? So I went and had a conversation with Bain, and I learned about the company, and I learned about the scale of the business, and I learned about how rapidly their product was being accepted. I did a lot of due diligence on the claims, and I thought it'd be really interesting. I've been around public company boards for a long time in my capacity at Viacom, and with other companies when I was representing companies and as a merger lawyer. So I liked changing that role from being a general counsel in the boardroom to being a chair. Mm-hmm. But I also felt I could add value to the company as it kind of went through this transition from private internet venture kind of financed growth company to public company.
With recent leadership changes at the company, is this to present a more sophisticated corporate structure than perhaps they've had in the past?
All right, so we starting with the board.
Yeah.
We've added David Ryan, who's an experienced corporate director with a finance background.
Yeah.
So you need in Australia to have 2 Australian directors. But in addition to that, we wanted to make sure, let me come back just a second. Bain, when we first had these conversations about coming in, it was about it being a real board. So from the very outset, the idea was that the board of directors was not about checking boxes. It was about having people with real relevant experience who had a seat at the table, who were going to help the business evolve in a positive way. So it's not just about compliance, it's about thinking about the business overall. And so we set out to think about who are the people who could best do that in light of all the things going on around the company. David came to our attention through people we mutually knew in Australia, and here's a guy who's been on boards of big companies, has a finance background, has been with banks, has been in investment banking. It's a set of expertise in Australia that we just couldn't have been more fortunate to have somebody who understands that set of things. Melinda, also a very experienced corporate director, also has a really great energy, business-like focus, knows her way around the rules here. And so while the big picture looks the same in the United States, an awful lot of the detail looks very different. So she was able to bring and is able to bring that to us. And frankly, it was a big vote of confidence, I think, to us when someone of her ability and stature did her own due diligence and concluded that this would be a great place to be. All of us are caught up in the excitement of the business, right? We're all caught up in the fact that this is something that can really grow, that it's really addressing a need in the marketplace. The total addressable market in deliveries is huge, right? You look out the window and you see how many delivery trucks there are doing all kinds of things, from food to furniture. It's a tremendous opportunity, and the customers are really benefiting, enjoying the product. So as the product rolls out, they're seeing real and immediate benefits to their business. So it feels like we're really onto something. It's growing strong double-digit quarter on quarter, and has been for a number of quarters. So we're just really excited about the opportunity. And so all of those things come together as to why I'd be interested in doing it.
And you're comfortable with Joel McDonald's ongoing role in the company?
Joel's great. I mean, I've been so impressed with the guy. Here he is, a professional football player, computer programmer, marketer, businessman, entrepreneur, and he really does all of those things really well.
Yeah.
So, he was smart enough to understand where his skill set was and the skills that he didn't yet have, because I don't know that there's anything that he can't do, but you can't know it all from the beginning. And so that partnership between him and Bain has been really strong. They're really strong partners. But no decision gets made at the company really without Joel at the table. And I'm just really impressed by how quickly he figures things out, about how capable he is in explaining things and interacting with people and listening, how good he is with customers, how good he is in understanding the product roadmap. He's a very talented guy, and he's a real asset to the business.
Michael Fricklas, thanks so much for joining us.
Okay, thank you.
Well, the Banking Royal Commission concluded today 69 days of public hearings. APRA's chairman Wayne Byers wrapping up today's proceedings in Melbourne with a court hearing that fees for no service is systemic within the industry. The Commission ended the week with Rowena Orr QC reading a summary of the Round 7 proceedings, saying counsel assisting will not identify any particular findings as being open to the evidence, nor will there be a process for the entities involved in this round of hearing to make further submissions to the Commission. Instead, we anticipate that the matters raised over the past 2 weeks will play a role in forming the recommendations that you make in your final report. And for our own summary of the Round 7 hearings and the highlights and lowlights of the entire Commission, I'm pleased to be joined by Michael Rodden, business reporter at The Australian, CEO of Climb Investment Management, Rod Bristow, as well. Gentlemen, thank you very much for joining me.
G'day.
Thanks, Leo.
Look, I'll start with you, Michael, because you covered so much of this. Finally, just the last couple of days, Wayne Byers, your thoughts on his performance and maybe kind of lack of probing questions, I thought.
Yeah, so it was a bit soft leading into the end of the fortnight of hearings, but basically the gist that I got out of the line of questioning at APRA was that they were too slow, they were too risk adverse to go after companies, and that Australia was basically behind the rest of the developed world in terms of global financial crisis reforms. So we saw that APRA knew about a lot of the problems, particularly within CBA. They knew a lot of the cultural issues. They didn't properly raise these questions with the board when they had the chance, and they knew that the way they were remunerating people was factoring into this, but they chose to not actually launch any action into them until late last year after the AUSTRAC scandal, when they launched the cultural investigation of them. So we've seen a banking regulator that was too wary, it was too trusting of the industry that it regulated, and that resulted in a lot of sort of reputational scandals, and we just hope that that doesn't filter out into a full-blown credit scandal.
I also want to bring in Annalise Nielsen, Sky News political reporter. Annalise, thanks so much for joining us. You covered a great deal of this, of course, as well. Taking it back to the early rounds of the hearings into wealth management, what really stood out for you and what surprised you? Perhaps we saw certain things coming and we really didn't see others coming, for example, AMP.
That was so much of the conversation going into it when they were going into all those enforceable undertakings right before the hearing started. Everyone did keep saying, well, we knew this was coming, we knew we expected it, but it really wasn't until we had the dead people being charged fees for advice that they obviously couldn't be taking up, that it really did start to go into the mainstream, because before that, the commission we saw was a bit esoteric, it was a bit of a side discussion, but that really put it front and centre for so many people. But as you said, it really did take to another level with AMP. I think no one really saw the misrepresentations to ASIC coming and just how many there were. Yeah.
I think it's fascinating too, because there was this question, how low can financial advice reputation in this country go? Because it certainly was pretty much at an nadir when they came in, and yet it just got worse. I mean, that surprised you, like these smaller, both the big guys and the little guys, the reputation seemed to get worse, despite FOFA reforms and all that's taken place in the last few years.
That's it, and it's interesting now seeing it all from the political perspective in Canberra, because there was so much of that conversation beforehand saying, well, we have the regulators, we are regulating the banks, we don't need to be doing this, and then you start seeing all the stuff coming out. And we did see that too in the recommendations or the interim report, when they were saying, when Kenneth Hayne was saying that more laws might not necessarily be the answer, but it might just be better compliance, because I think that was one of the other surprises, was that ASIC was across a lot of these issues but wasn't using the powers that it had to enforce. And so there are going to be some really sweeping changes we're seeing in the financial advice area. There's already new compliance regulations for the qualifications that financial planners and advisors will have to have from January 1st, and that's already becoming a bit of a political football, because there are issues with how people are going to be able to comply with the education requirements in such a short amount of time.
Right, I want to bring you in here. Structurally, what has been the damage to the banking sector in Australia? The last week we've seen the bigwigs give evidence. Did it surprise you? What kind of stood out for you there in that evidence as well?
Yeah, I think what really stood out is how well coached all of the CEOs were in terms of their responses. You know, you really saw the CEOs who were across their brief, and you saw the ones who probably needed a little bit more time to be studying. But I think the key thing that came out of it is that, you know, now everyone understands just how serious this is, and this goes not just to you know, the issues of misconduct that have been raised. I think it really goes to culture, and you know what happens here in terms of the cultural change that I guess society expects of the financial services sector. That's really the key takeaway for me.
Yeah, and what about banks as an investment now? I mean, have we hit this low point? Or do we see any kind of recovery, or is it continuing going backwards?
Yeah, I think we need to wait until the report comes out in February. The Hayne report comes out in February, but in between now and then, I think there's some pretty important lessons to come out. You know, when you look at banks as an investment, particularly for an SMSF investor who might have been holding banks historically, generating dividends, etc., you know, I think that model is going to change, and what that means is effectively, you know, the cost side of the equation is going up. Banks are simplifying, they're deleveraging out of their wealth management businesses, and we've seen all of that happen through the course of the commission. And so the cost side of the equation is going up. Banking businesses are getting simpler, and in getting simpler, are they giving up growth as a result?
Michael, quickly, your highlights or lowlights of the commission overall?
I loved Terry McMaster, who collapsed on the stand and had to get taken out of the Royal Commission on a stretcher and put into the back of an ambulance, and then still had the temerity to say that everyone was smearing his reputation and that there was no problems to see here, despite having the world's most Orwellian client protection document in the world.
All right, has your highlights or lowlights, Annalise, big master aside, I know you were there. You filmed him going to the ambulance. I shouldn't laugh, poor guy.
I am in the background of every one of those photos. That's one for the history books for me. But I think it was sitting there when AMP was being drilled down by, I think it was Michael Hodge, who was saying, how many times did you misrepresent ASIC? Was it 5, 10, 15?
Yeah.
And he couldn't even name it. That was when I think we all realised just how serious this thing had gotten.
Yeah, and has changed the face of that company, cost them a chairman and chief executive. Well, Michael Rodden from The Australian, thanks so much for joining us. Annalise Nielsen from Sky, thank you so much for your work. And Rod Bristow from Climb Investment, thank you.
Thank you.
Well, after the break, we'll get a wrap of this week's company news with Macquarie's Martin Lakos and CMC Markets' Michael McCarthy.
Now, back to TICKY.
All right, moving to markets now, and the ASX 200 was down 1.6% at the end of trade today. Coca-Cola soaking up those losses, closing down around 15%. The index down around 0.6 for the week. It was another big week for the market. We had a number of key AGMs for investors and a lot of anxiety leading up to this week's G20 summit in Buenos Aires. For a roundup of the week that was, I spoke to Martin Lakos from Macquarie Wealth Management and Michael McCarthy from CMC Markets a little earlier. Martin Lakos, Michael McCarthy, thanks so much for joining us. Look, let's start off on Myer. I'm really interested as to where this goes. I just spoke to Solomon Lew, asking him what his grand plan was. Obviously, he didn't reveal that to me quite, but I'm interested in where you think this all goes from here.
Well, I think, first of all, looking at Premier Investments and Solomon Lew, the reality is time is on their side. Yeah. We've seen a second strike on the remuneration package today. That means there's a guaranteed board spill in 12 months. It's pretty clear that Mr Lew is agitating for change. Now, the new CEO's only been in the seat, 6 months or so. So shareholders, I believe, will give him an opportunity. But in 18 months' time, there'll be enough runs on the board for them to make a decision. And I'd suggest that Mr Lew's plan over the next 12 months is to garner enough support for radical change at the board level. What that then means for the Myer business is a very open question. Premier Investments have done well in a tough retail environment, and I'd suggest that we're going to be looking at an importation of their strategy, and that is a concentration on particular brands and a breakup of the department store model.
And in the meantime, Mike, the retail sector is continuing to do it pretty tough, isn't it? You know, we're seeing that households aren't out there spending with the way we'd like to see them spend. That may change if wages growth starts to improve and household disposable income picks up as well. But, you know, Myer's been well and truly caught up, hasn't it, with this pretty soft retail environment?
Oh, absolutely. We saw that this week with Harvey Norman's AGM and the railing that Jerry Harvey was doing against the short sellers. But he can't change the overall retail environment. And there's both structural and cyclical threats to almost every retail business in Australia.
Well, yes, your point about the board and Solomon Lew's position is very accurate. The other question is, though, do they last another 12 months? I mean, do they get through 12 months without perhaps going into administration? If they do, he's not in a bad position at all. I mean, this is the other theory, that he picks up the company without having to buy it, right?
Well, the cynical trader in me points out that most of the value destruction in the share price has already taken place, and so those shareholders are hanging in for a recovery, in my view. I think they'll having stuck with it this long, they'll be patient.
Sure. Now, Coca-Cola getting smashed today. It's the sale of part of its business. Lowest share price now, I believe, in about 4 years. I mean, what's going on?
Well, so here are the real problems. So there's headlines today were about SPC and Coke's plan to sell that business. Now, let's remember, between Coke and the Victorian government, $100 million has been pumped into this business over the last 4 years, and they're still reporting a $10 million loss this year. So lessons there for governments in terms of investing in failed business models. But the real key question, and I think the reason why we've seen the share price drop by more than 14% in trading today, is the Indonesian business. And they're getting a perfect storm there. Costs are up, demand is down, and the currency is working against them as well. And given that Indonesia was the great hope for growth for CCL. That failure is really weighing on the share price. And the problem for Coke is they've tried so many things. They've tried bottled water, they're trying kombucha and iced tea, they've tried foods, they're trying geographic diversification, and nothing is working.
And it's been Lou, but it's been an incredibly maturing business for quite a number of years, both at the main brand level, the Coke brand level, as well as when you think about bottled water, pretty competitive. You can't add a lot of value. You know, you want to expand your distribution base and your customers. But you know, again, failed strategy in regards to food. It's a tough business, and it's certainly one to continue to steer clear of, I think. Yeah, well, as you said, with retail, there's only so much you can do about a structural environment. Absolutely. A structural environment against sugary drinks is not good, especially with the likes of maybe a sugar tax on the horizon under a Labor government. There's all these ideas, and they're being taken very seriously. And remembering where Coke's come from, 20 years ago, Coca-Cola was the second most well-known brand name in the world. There's only one place to go from there, and it's not to first. So. Now, the Nine Fairfax merger got a sign-off this week. No surprise, despite Anthony Catalano's last-minute bid. I'm not entirely clear what was actually going on there in the end. Far be it for me to call it tilting at windmills, but nonetheless, yes, unsuccessful in his attempt to break it up. And this does look like the best opportunity for both of those organisations. The reality is they need to evolve, and they need to evolve pretty quickly. And banging these businesses together might give them the opportunity to strip out those poorly performing aspects of the media business and concentrate on those areas where they have got potential for real growth.
Well, that's all for the show tonight. Tune in on Monday. Ticket will be back Monday, 4:30 Eastern Standard Time, or you can rewatch tonight's episode at 10 p.m. Thanks for the company.